Okay, good evening, ladies and gentlemen. Right, this course, let me inform you, the lesson that we are doing today is serving two purposes. One, it is being done in partial fulfillment of the requirements for the postgraduate diploma in higher education, the course being e-learning in higher education. At the same time, it's being done as a lesson or a lecture on financial management. And the topic that we'll be looking at today is risk and return. So if you feel you've got a question, you can stop me at any point, interject, you just unmute, right? Then you ask a question. I will see and I will try to respond to it. Okay. So we have got learning standards. Learning standards are the benchmarks or the things that we must learn or understand by the end of the class. We are interested in the concept of return, and we're also interested in the concept of risk, then the concept of covariance. Okay, we'll be explaining this in detail. But to start with, let me just give you some highlights of the objectives that we want to achieve by the end of this lecture. Number one, we need to define risk and also define return. Then we'll also be expected to be in a position to analyze the relationship or the trade-off that exists between risk and return. Then we should also be able to measure risk and return by calculating expected return, standard deviation, and coefficient of variation. Those are the three objectives that we want to achieve, right? We have got a number of resources that can help you to get to understand this. We have got the FMA course study guide. If you go to discussion 6, if you are not having access to this, you let me know so that I help you to see how you can get it. Then we've got those textbooks that are indicated there. There are two textbooks that you can find helpful. The Financial Management Theory and Practice, 14th edition by Eugene Brigham and Michael Ernat. Then we've got the Economist Guide to Financial Management, second edition, authored by the Economist and John Tennant. Those are the main resources that we have. We also got a video link that can educate you nicely on risk and return, as well as CAPM or capital asset pricing model. Right. Now, the outline will be very short. As you can see, we'll begin by motivating the risk and return concepts. Then from that, we shall move on to segment 2, where we'll be calculating return. Then we move on to calculating risk, then calculating covariance. We will end there. Let me begin by motivating the concepts of risk and return. All right. These two concepts of risk and return are a fundamental in the study of finance or in our finance theory. Let's have a background of what we mean by risk and return. Let's say you are an investor and you are given two options to invest in a low interest, a low risk project, giving a yield or a return of 10% on the monies that you would have invested. And secondly, the other option, you are to invest in a high risk project paying 10% return. Which of the two would you prefer? Can somebody unmute and feedback me on that one? The project that has got a high risk and a 10% return, and the other one has got a lower risk, right? Isolda, can you unmute and give me an answer to this one? Right, we've got one, it's a low risk project paying 10%. Okay, looks like Isolda, you've got a problem of unmuting. Do you understand how you can unmute and mute using Zoom? Isolda, looks like she has left, right? Okay, we've got project, the one that can have a higher risk, and then the other one with a lower risk. Okay, under normal circumstances, most people would choose to go for the one with a lower risk. Yes, I can see. Were you struggling to unmute Isolda? Are you there, Isolda?
Yes.
You are too low. I had asked the question there, but I had answered myself.
Is it your internet that is acting up, or why?
Is it acting up? Let me see. Tanyaradzwa. Can Tanyaradzwa unmute and answer me? Are you getting the signal clear, or it's cutting and freezing? Tanya.
No, sir, it's very clear.
Cutting.
Tanyaradzwa, what is your feedback?
It's clear on my side, sir.
It's clear on your side?
Yes.
Oh, all right, that's fine. I think next time, okay, we'll just carry on. If you're not getting it clearly, Zoda, we shall give you a record, because I've got a control center that is checking the signal. They are saying the signal is okay.
Oh, okay, then it's probably mine.
All right, I'll go on, and I'll tell you when I'll be. What I will have to do, I have to add some slides when I'm getting to questions, so that you see that now I need people to ask questions, perhaps in case you're not getting me clearly. All right, let's move on. We were saying that the principle, if you look at bullet number 3, the principle, right, we follow in finance is that investors need some inducement of higher reward to take on perceived higher risk. In other words, what we're simply saying is investors, they don't want to accept or to take uncompensated risk. The higher the risk, the higher the return they want. So the higher return will be needed in order to compensate risk, right? So looking at what risk really is, it's basically a uncertainty. I can say risk is just uncertainty. We can define risk as the chance of posting or getting a loss in an investment or an undesired income. But look, let us look at the definition that is given here. It's saying income received on an investment plus any change in market price, usually expressed as a percentage of the beginning market price, is what constitutes a return. Okay, so the concept of risk is about uncertainty. Let's say we're expecting to get a yield, what we call a yield, or we've made an investment and we want to get something from that. That which we get as profit is what we call a return or a yield or earning, right? That is the concept of return. Now, there is a formula that you can see down there. I hope you can see, right, my cursor. If you look at that formula, it's R is equals to DT plus opening bracket PT less PT minus 1 over PT minus 1. Right. Let me explain what is happening here. This DT is representing the dividends. When you made an investment, let's say you buy common stock, you will be getting from that a series of dividends during the lifespan of the investment. And this one, PT minus 1, it is the original price for which you bought your stock or asset. Then PT, it's at a time that is plus 1T. What am I saying here? Let's say this year or last year, you bought an asset or a stock for $20, right? So last year becomes PT minus 1. Today, we look at the price. That asset perhaps which you bought for $20, if it is now $25, it simply means now that it's now 25 minus what? Minus 20. Over the, we divide by the original price of 10. All right. Now, let's move further, right, to that example that you can see. The stock price, let's say you are given an example which is as follows. The stock price for stock A was $10 per share 1 year ago, right? The stock is currently trading at $9.50 per share, and shareholders just received a $1 dividend, what return was earned over the past year? That is the question. What return was earned over the past year? Now, what we do there is we look, right? We go back to our formula, right? Remember, the stock price is $10, right? A year ago, it was $10. But at the present moment, it's trading, market trading at $9.50. What it means is it has fallen in value. But remember, there is a dividend that was paid during the course of the year, a dividend of $1. Then the question is, what return was earned over the past year? Quickly look briefly at the formula. I just give you about 10 seconds, then we carry on. Right, I hope you can see now. All right, the dividend, that is the DT, that's the $1. Then plus, right, $9.50, which is the current price, minus $10 over the $10. If we work out this, we get 5%. This 5% will be our return. Okay, are we understanding what I'm doing so far?
Yes, sir.
Okay, you can understand. Isolda is not responding. I'm not sure what is going on, right? Okay.
I can hear, sir.
You can hear. All right, so far,
Yes.
are there any questions from what we've said so far?
No, sir.
It's okay.
It's
Right.
okay.
Tanya, can I carry on?
Yes, carry on.
All right.
Yes, sir.
Okay,
Go
thank
on.
you. Right. Now, let us define what we mean by risk. Risk, okay, it's the variability of returns from those that are expected. Let's say we made an investment. Every time we make an investment, we are expecting to get a return. All right. Let's say we bought stock for $20 and we expect to get, at least on that investment over the period of 1 year, we expect to get $5 a return on the $20. So the $5 becomes the return, okay? This $5 as a percentage, we can say 5 over 20. It gives you what? 5 over 20, it's equal to 25%. That will be the return. If that is what we are expecting, right? It becomes our expected return. But what happens is, whilst we are expecting or we want a return of 25% on this investment, the world of business doesn't dance to our tune. We expect it, but things may go differently. Instead of getting a return of 25%, we may get 20, we may get 15, we may be lucky enough to get even 30% on that. So we have got uncertainty. We're not 100% sure that we'll get 25%. That uncertainty, the level of uncertainty, is what we call risk. So we can define risk as uncertainty. We can define risk as the chance of getting an undesired outcome. We can also define risk as the probability of us not getting what we're looking forward to getting from our investment, right? So what rate of return do you expect on your investment, right? Let's say you expect 25%, right? Then at the end of the day, after the year, what is the actual rate do we get? Perhaps we get 15 instead of the 25. Therefore, it means we have what? Not obtained what we're looking forward to getting. That is risk. And now, if you look on the slide there, that is the formula for risk. Don't be frightened by the figures that you see there. It's just a high sounding nothing, right? Let's try to unpack what is in this formula, right? So these are, okay, let's look at this one. It's R bar. I'm sorry, this one, it is trade. Like, look at what is appearing here. R bar. R bar, it simply means the expected return for the asset, which could be our stock that we bought, which could be an investment in a taxi business or in a brick molding business, whichever the case may be. That is the expected return. Why are we saying expected? Expected here, the Arab bar means it's the mean. The mean is the average. So we are saying there are different returns that we can get. Remember our example where we're expecting 25%. We can get 22%. Or we're expecting in dollar terms the $5, the $5 out of 20. We may get $4. We may get $3. We may get $6. We may get $7, right? But when we look at all those probable returns, we are saying what is the average of that? If we get the average of that, that becomes our expected return, the most likely return, okay? So Araba is the expected return for the asset. Then we have got this sign, it simply means summation, okay? This stands for summation, right? So we are saying out of all the probabilities that we have, the likely returns that we can get, starting from the first one, right? The first one is what we call 1. Let's say there are 10. The first one is 1. Up to the last one, n will be representing the last one, the 10. If there are 6, n will be 6. So we're saying what we're summing here, we are summing these signs I multiplied by pi. It's simply a multiplication. So we'll be saying the probability of R1 multiplied by what? The return R1 multiplied by what? Its probability, corresponding probability. So we'll be having several of them. I think the next slide we'll try to illustrate that with an example. I think it will be clearer for you to understand what is going on. But here we have got several errors, right? Return 1 probability, perhaps it's 5%. Return 2, perhaps probability is 20%. So we'll be multiplying each return and its corresponding probability. Then at the end of the day, we sum up the products. Okay, so Ri is the return for the ith possibility, right? And we can have R2, it will be returned for the 2nd possibility. R3 will be the return for the 30th possibility. The same goes with the P, right? And N is the total number of the possibilities that are under consideration. Now, what I've just said, let's look at this example. Let's say we buy stock and we call this BW. It's a stock. It's for a company called BW. So there are different probabilities depending on the state of weather or whatever the situation may be, right? The return that we can get may be minus 15. And what is the probability of it being what? Negative. It's 10%. The probability of it being negative 3%, it's 20%. The probability of it being 9%, which is 0.09, is 40%. The probability of it being 21 is 20%. And the probability of it being 33, it's 10%, right? So remember, it was summation. The summation formula simply means we multiply Ri by Pi. What is here? We multiply it with what is corresponding. Hence, we get Ri, Pi. And when we have obtained all these, what do? We sum them up, right? After summing up these up, we get a figure of 9%. Is my signal still okay?
It's still okay?
It's still okay. All right.
Yes.
Thank you very much. Right. Let me proceed to the next slide. Okay. Now, when we are calculating what? Risk. We are calculating the standard deviation. Okay. The standard deviation. And what is the standard deviation? You see, the standard deviation, it's the metrics that we use to measure variability. Okay. So what we do is the formula for standard deviation, it's equals to square root of summation R minus R bar squared multiplied by probability I. That is how we calculate this. Of course, you get to see this when we look in detail at when we present this in a tabular form, it will be easier for you. But let me just elaborate on the concept of what standard deviation. Standard deviation, we are dealing here with what the Poisson distribution and the normal distributions, right? So what is happening here, you can see this is a normal distribution, right? And the mean, which is the average, is in the middle. The mean it will be equivalent to the expected return that we talked about. And when it's at 0 here, right? If there is no standard deviation, so we're strictly at what? At 0. But since we say the probability may what? May waver around. So it can fall anywhere within this bell shape or the normal distribution. This is the concept of standard deviation. So if our standard deviation is small, it means the degree of variability is very small. The chance of us not getting what we are expecting from an investment is less. But if it's wide, it means there is a probability that it can be anywhere within the wide region. Therefore, the risk will be very, very high. That's what we are simply referring to here. Right. Let's look at the formula in detail of calculating risk. We said it is the summation of what? Risk I minus R bar closing bracket squared multiplied by probability I. Okay, right. So if this is the case, what we are simply doing, we tabulate those returns. We started with a return of negative 15%, followed by negative 3%, then 9%. And for each one, we had a given probability. And one thing that you must always remember is probability always add up to 1. Probability always add up to 1. Now, so what we do is we multiplied, first of all, this is the part that we played to get the what? The expected return. This is our R bar, right? Which is just a summation of this. Now, what we are going to do now with this figure, we are going to say R, right? This one minus R bar. So for each one of this, we'll be subtracting this one to get these figures. So to get these figures, this figure that you can see here, we said minus 0.15 minus 0.090. It gave us this, right? Then we squared it, right? After squaring it, we multiplied by probability. That's what we simply means. What it simply means here. So at the end of the day, having done that, we now sum up, find the summation, we get to this. This figure that we're getting here, right? We obtained it by squaring up these figures. You may want to find out why is it we are squaring these figures. It's because some of the figures are negative. So we are looking at the distance from the mean, from the average, and the distance is never given in a negative. So we are squaring so that we can get positive figures. That's why we squared the minus 15. Everything here we squared, right? So when we summed the squared figures here, we got this figure. This one is not the one for standard deviation. It is the variance, right? For us to get the standard deviation, we need to find the square root of this variance, right? The relationship between standard deviation and variance is that standard deviation, it's a square root, right, of a variance. So in our next slide, we show that, okay? This is the formula that we used, the one that we showed on the table. And this is the figure that we just showed you, right, from the table. Let me go back there. You remember 0.01728. It is the figure that is appearing here. And this is just the formula. Remember, we were squaring, we multiplied the R, right, by R by PI, then we summed up to get the what? The R bar, the expected return. Then next went on to say R minus R bar, which was 0.09. And we got those figures after squaring them and multiplying with the probability. We summed them and we got 0.01728. And we said that is what we call a variance. And the relationship between standard deviation and variance is that standard deviation is the square root of the variance. Okay, that's why we are squaring it here so that these become equal. So simplified further, the standard deviation will be 0.1315 or 13.15%. This becomes our risk factor. And what does this tell us? It simply tells us that, remember, we had an expected return of 0.09. And this standard deviation is simply telling a story that there is a 13.15 chance or 13.15% probability or a chance that will not get that return of 0.09, which is 9%. So what is the certainty level? We are therefore, if we subtract this from 100, we'll get 86.85. The 86.85% becomes the level of certainty that is there, but the risk is 13.15. In other words, we are saying there is a 13.15% probability that we will not get the return that we calculated earlier on, that return of 9% or 0.09. Do we have any questions so far?
No, sir.
No question.
No. Is order?
No.
Oh, so I should proceed.
Yes.
Okay. All right. Thank you very much. Let me proceed to the calculation of now the coefficient of variation. The coefficient of variation is just measuring the relative risk, right? It is the ratio of the standard deviation of a distribution to the mean of that distribution. Our mean, our distribution, we found it was 0.09, isn't it? And the standard deviation, we calculated it and we found it was what? 13.15% or 0.1315. So the formula now for coefficient of variation to measure the ratio of the standard deviation to the mean, it's simply what? Standard deviation divided by what? R bar. R bar is 0.09. The risk with standard deviation is what we've just calculated, which is 0.1315, right? Right? I think we are being warned here that we've got about 10 minutes to go to the end of the class, but not a big deal. I think we'll be done by then, right? We'll be done by then. Can I upgrade? Let me just upgrade. I think it is upgraded. Right, so we carry on. Here are the normal distributions. The normal distributions. So what is simply happening here within the normal distribution is we are simply saying, right, we might be having those variations that you saw. We had 0.15, we had 0.039%, 21, and 33, right? Something like that. Okay. So what is simply meant, this one was our normal one, right? So this is our presentation. I think before we get to the end of this, right? Okay, let's get on. We will just carry on. And here we've got a what? The normal distribution. That is what it means. The one, our expected return will be at the center, right? It will be at the center of the bell shape or the normal distribution. But there are probabilities that we will not get that 9% from our investment. It can waver this side, it can waver this side. Instead of getting this, we might get other things such as that, right? So let me go to the next slide. All right, we come to the end of our presentation. Do we have any questions that you may want me to attend to? Isolda, Tanya?
No, sir.
Okay.
No, sir, it's all fine.
Everything is okay. All right, what I'll do, I'll be stopping the presentation now, but what we'll do is I'll email you a copy of the assignment. Then in our segment, we'll be looking at what return and risk of a portfolio or a group of assets. So for the time being, it's bye-bye for now. Thank you very much.
Thank you, sir.
Bye.
Thank you.